Hello, this is Those Boring Politics from Tumblr.com, and this is going to be an explanation about why the 2008 financial crisis was a result of government. When having a dialectic, and more often than not a debate with people, we tend to offer up in discussion what has and has not worked. Well, a big arguing point for those who wish to regulate is the 2008 financial crisis. At which point I go on with a huge explanation that is quite the pain to type out quickly in a discussion while still being A, grammatically understandable, and B, as well thought out as it could be. So I'm making this post as reference not only for those who I engage in a good old debate with, but for myself as well. Let's start at the root of the entire thing, the banking system as a whole. It's no secret that when depositors put money in the bank, they leave it at the discretion of the bank. It's in the bank's best interest to loan out most of this money and only keep a fraction of it in reserves for withdrawals, thus the term fractional reserve banking. The banks usually expect not many withdrawals given a stable economy, so the more they loan, the more money is paid back to them. They believe this system to be sufficient enough to meet the demand of depositors' money. Let's focus on the system's effects on credit. Credit is pretty much a fancy word for loans, money a borrower doesn't have at the time that they promise they'll either pay back over time or at a later date. Credit can make or break an economy. No credit means that things are stagnant, and a lot of credit means that a lot of people have money. Credit card companies, for instance, give huge amounts of credit to consumers, boosting aggregate demand for businesses and increasing spending. Though in the fractional reserve system, absolutely too much credit becomes available, and I'm about to show you why. The amount of consumption becomes disproportionate to savings and investments. People and firms take all this credit and use it to invest. They do this because if they don't, they know other people and firms will, and they'll just be mowed over by them with all of their profitable transactions. They're forced to compete using the credit. It's what we in the Austrian school address as malinvestments. But credit ends at some point. People have a change in time preferences, or people stop needing it. Sometimes people start to not even have it available. Depositors at this point will go and withdraw money from the bank because there's going to be a demand to restore the old proportions. The bank isn't going to have much liquidity and start demanding payments from its borrowers. Borrowers lose credit, demand goes down, and loans stop. The credit retracts. This is a credit crunch and leads to runs on banks as people demand their money. But the money won't be there, since the banks loaned it all out and people simply can't pay back the banks quickly enough. And remember, right now, for every dollar you put in a bank, 10 cents are created through credit. So all the money is inflated by 10% eventually, which inflates over and over. This means that probably the money you deposited into the bank doesn't even exist anymore. It spells catastrophe for every economy. Now, one who normally doesn't read my blog would blame the banks and call it a failure of free markets. But I would disagree. Central banks actually encourage these policies and push money into the reserves of banks for lending themselves. They push for credit creation, and they also enable the fractional reserve system. They do this all with the guarantee of bailouts for the banks. It happens every time. The reason they do this is before the markets clear, the credit crunch, there's a boom. And it's a beautiful boom where everyone is making money and everyone's buying and everyone's selling. The boom is where the story of 2008 comes in. It's essentially the overexpansion of credit in the money supply to a point where it's absolutely unsustainable. The markets clear, the bust, and the credit halts entirely and everyone loses money. It's the credit cycle, also known as the Austrian business cycle, and it seems to happen every time. Let's delve into it. We'll start with the Americans aspiring to be homeowners. They want to buy the house, but they simply can't. So what do? They take a loan from the bank to help pay for the house. This is a mortgage. They promise to pay back the mortgages over time plus interest. When the banks loan the borrowers, they're losing money temporarily. Sure, they'll gain a profit back, but for the time being, they're boned. So what do the banks do? Well, they put all these mortgages into a securitization process. It's a very lengthy process to explain, so I'll explain it very briefly. They bundle these mortgages together. They then split these groups of mortgages into tranches, slices, and sell them off to investors. These are commonly referred to as collateralized debt obligations, CDOs, and mortgage-backed securities, MBSs. The banks will pay back the investors of the securities over time plus interest. Security in this sense is a form of debt. Banks do this for a few reasons. For one, having lent to a borrower is a risk because there is a risk of a credit default. This means the borrower will say, I can't pay this back, and that's it. To bundle these all together and sell these off will decrease the risk and eventually move it off the bank's backs. The banks have risk of not having liquidity if someone defaults, but when they sell these CDOs, they now have liquidity to pay for it. The investors are collectively financing all of the mortgages. They're financing the borrower's debt. Now, the banks who were securitizing these loans were making huge amounts of money. These were namely Fannie Mae and Freddie Mac, as well as other banks that also pooled mortgages together. So when they all went to lenders and said, this is really good, but we need more, the lenders said, we're already giving loans to people with good credit. So, since they had to give more, they went for people who had really bad credit ratings. Fannie Mae and Freddie Mac also did this, as they were designed to offer credit to those with lower credit ratings. If the banks didn't utilize the credit given to them by the Federal Reserve, the central bank, it could have been detrimental to their business. Now that's the fault. That's where the fault comes in. The entire banking system expands credit to extreme amounts. This is enabled by the Fed. Then the Fed pushed more credit into the system. This gave the banks the ability to give mortgages to people the banks knew wouldn't be able to pay it back. So they lent these mortgages out and bundled the subprime mortgages with ones that were practical loans to make it look good. They sliced these up, and the process repeated with investors. But now there was an issue. The banks saw this new liquidity coming from the security purchasers as an opportunity to loan even more. More loans went out and liquidity went down. They rinsed and repeated. This was a huge risk as they knew that the subprime mortgages were going to start defaulting. So what did the banks do? They bought insurance. They bought credit default swaps. This means that when someone defaults on the credit, the liability is swapped to the insurer. Now, why would the insurer agree to this? Huge amounts of fees relative to the huge amounts of loans given out. It was a money fest for companies like AIG. The banks knew that the subprime mortgages were a huge risk and that large amounts of default would happen. The insurers, however, AIG for instance, thought no one would ever default and that the housing market would simply keep going up. So when people with bad credit all started defaulting, new houses became available to the market. When the supply of houses went up drastically, obviously the prices of these houses also went down drastically. So people all of a sudden had mortgages out from the banks that were twice as much as the value of their homes. No payments are being made to the banks, but banks still have to pay off the investors of the securities. With what money, though? Well, thank the Lord that the banks got insurance on that. The insurers will pay it off as agreed, right? Wrong. The insurer, if you remember, thought that the market would keep climbing. They don't have the money to pay off the security holders. They suffer huge losses and go under. The banks are left to repay the CDOs and suffer huge losses as well. All at once. They crumble as well. It made the entire financial system collapse until the federal government bailed them out. When the whole thing fell apart, it was deemed too big to fail. If the banks fail, then you can count on a complete depression. And it's true. But bailing these corporations out is a bad idea, especially since it's the government-created mess in the first place. Remember, it all collapsed because of how much money was involved. The major losses came from an overexpansion of credit. It meant making very unwise loans and trying to make money off of it. Without the policies of our central bank, the Federal Reserve, credit wouldn't have been able to reach the purchasers of subprime mortgages. Less money would have been involved and investors would have been happy. Money would have been made by everyone for longer, and when the burst would have come, it would have been a lot softer. Insurance companies would have been able to pay out when the banks asked it, though people wouldn't have been able to default nearly as much in the first place. And investors would all be paid back. If there wouldn't have been a soft burst, there would have been no burst at all, considering people would all be paid off quicker and easier before more loans are made. Overexpansion of credit is to blame, which is a result of cash forced into banks and fractional reserve banking, which is ultimately caused by a central bank, in this case, the Federal Reserve.